The SEC Commission just opening a window into how it might be planning to make the biggest set of changes in years to how you trade stocks. SEC Chair Gary Gensler today came out with major proposals to shake up the U.S. stock market, and those proposals include upending the practice known as payment for order flow. This afternoon, Gensler, speaking before the Piper Sandler Global Exchange and FinTech Conference, said his staff is actively studying whether to route equity trades into competitive auctions versus through the 2 or 3 wholesalers such as Citadel Securities and Virtu Financial, who are a couple who currently hold the power. Gensler questioned whether wholesalers may not be passing along the best execution price to individuals and you, the trader.
Right now, you see, there is not a level playing field amongst the different parts of the markets. The wholesalers, the dark pools, the lit exchanges, what one might call market centers. And so further, the markets have become increasingly hidden from view.
As Gensler hints, the opportunity to execute trades should be now up for auction. We have team coverage of what this means for you and your portfolio. Our floor show traders are standing by to give their insight and decades of experience in trading on how this could affect the future of trading. But first, we begin with Charlie Gasparino, who's got the nuts and bolts of the plan Gensler just revealed. Charlie.
Well, this is essentially reversing the market structure that was laid out by the SEC about 10, 15 years ago. I believe it was under Bill Donaldson, where essentially it allowed the order flow, that means trades, to be placed not just with the New York Stock Exchange and NASDAQ, but to distributed to various private trading venues, also known as dark pools. We should point out that goes beyond just Citadel and Virtu. It's other players, and it's what the SEC at the time wanted to do was have a competition for order flow that would make prices that would redound to the small investors go, fall. Okay, so here we are in 2022, and we have Gary Gensler without any evidence saying that essentially small investors are paying more. And what we have to do is go back to the old way of doing it and essentially reroute all the order flow to what's known as the lit exchanges, NASDAQ, the New York Stock Exchange, and maybe a few others, where their prices are put up so everybody can see it. Now, here's the problem he's going to have. Number one, he's going to be challenged by the discount brokers. They're going to fight the SEC on the evidence that investors are getting lousy prices. That's number one. And it's going to be a tough one for him because there is no academic research and Wall Street research out there that suggests they are. None. I can tell you, I've been looking at it for a long time. At least it's a huge debate whether you're getting a worse execution, but you get a cheaper trade. So this is a very complicated area, right, and it's going to be hard for the SEC to prove. The second thing is he's going to face a ton of backlash from Congress, the Republicans in Congress, who again believe that these sort of competing markets are the way to go, and the Republicans are going to run Congress. And number three, we should point out that Gary Gensler, everybody knows it. He's said it. He wants to be Treasury Secretary. The person that he answers to the most is not the president, but it's Elizabeth Warren. So if any TV commentator, if anybody, any investor thinks this is a good plan, you have to remember one thing. This is a plan that's being endorsed by the bank-hating, Wall Street-hating, investor cynic known as Elizabeth Warren. Just keep that in mind. Back to you, Liz.
Charlie, thank you very much. Look, this issue comes down to one critical question. Are you, the investor, getting the best possible price of a stock each time you execute a trade? Because that's what Chair Gensler is scrutinizing the most. So let's bring in Teddy Weisberg and Dutch Masters, 2 traders with decades of experience. I think between the two of you, we got like 217 years of trading, guys. Teddy, I'll start with you. Once again, just to reiterate here, payment for order flow is the compensation that a broker, the Charles Schwabs, the Robinhoods, the Ameritrades of the world, receives for routing trades to a particular market maker or middleman, who then in turn gets compensated based on the spread between the bid and the ask price. Teddy, is the public, as you've seen it through your experience, getting the best price with the current system? Because Gensler made it clear he really doesn't think so.
No, and I happen to agree. Liz, I've been doing this for 60 years. For most of those 60 years, if I got rebated or got a kickback, if you will, because a rebate is nothing but a kickback for directing order flow, I would have gone to jail. You know, this whole payment for order flow is a byproduct of Reg NMS, which was basically invented by the SEC and Congress, I don't know, 10 or 15 years ago. And it's the unintended consequences of how they changed the landscape of how stocks are traded. I would suggest to you, number one, that at Seaport, we don't sell our order flow for a lot of reasons, but we don't need to do that. We know how to get best execution for our clients without doing that. Number two, the whole fundamental argument for payment for order flow implies that there's still too much vig between the bid and the offer, and that simply allows firms like Schwab to offer free commissions, but they're not free. They're not free. And so the argument is that the retail customer is not disadvantaged. I would suggest to you, as Charlie might have alluded to, it's almost impossible to figure out. But the fact that they can pay for order flow, which for forever had been illegal, and is illegal in most businesses, and yet offer free commissions, I think is kind of a lost leader, like giving away the Coke to sell the cereal in the grocery store. I think the customer will be much better served without a payment for order flow. Business
but then paying
plan.
for a commission, paying some type of commission for the trade, right? Because people look. I think what you just said is really, really insightful. What part of this is really free?
There is no such thing. There's no such thing as a free lunch, and I can assure you, and Charlie, and I don't know Dutch, and Dutch, that there is no such thing as a free trade. But it's the perception, because they don't pay a commission up front, that it is free. But the fact is, it is not free.
Dutch, what side of this do you take, and what do you welcome that Chair Gensler put out there, and what do you think would be a huge mistake?
Yeah, I got to tell you, I'm on the other side of this, so I don't broker trades for customers. We trade our own accounts, and so, you know, I'm on the buy side. So I'm always looking for good execution. And let me tell you something. I started this business a long time ago, too, okay, 30, 40 years ago, and I got news for you. We had $2 bid asks, okay? We had commissions on top of that. We had executions that took forever to find out whether you even got executed, okay? 10 minutes, 15 minutes, 20 minutes, okay? It was antiquated, and compared to what we have today is a dream, okay? It's a dream, okay? Everybody knows that the free commission isn't free, okay? They're not trying to hide anything. They've disclosed it. It's instant execution, and if you're looking for a fraction of a cent difference, you know, you're basic. What are we arguing about here? A fraction of a cent? Come on. I mean, the bid asks are a penny, man. I mean, I'm getting lightning executions in, out, whatever I want. This is a regulator who's basically doing his job to justify his job, okay? There's nothing nefarious going on here. They're not slamming me for $2 a share like they did 10, 15 years ago, 20 years ago.
What about that? Okay, so let's let Teddy get back in here. Teddy, your response to what Dutch just laid out.
Well, I think Dutch, the reason, you know, yes, I would agree with you that things have evolved and it's faster and more efficient. But a lot of that is a byproduct of going from fractions to decimals. And now we're talking about, and I think Gensler mentioned this just yesterday, they're talking about going to fractions of pennies. The fact is, if they go to fractions of pennies, they might solve the problem without doing anything. Because if they take all the vig out of the trade, there'll be nothing to rebate. And then by default, they'll go back to the retail customer paying commissions. But no question, we've had changes that have had plus and minus effects on the business. I would add to this, Liz, you know, if they want to level the playing field, dealing with payment for order flow is one, and the other topic is the short sale rule, but that's a topic for another time.
Well, we're looking at Charles Schwab and, of course, Robinhood, a couple of these other names of these discount brokerages. Virtu, of course, is one of these market makers. It's at the low, well, actually low of the year at the moment. Looks like, but down about 2%. So clearly the markets are reacting, and some of these individual names that could be involved are watching. You guys, this is one of my most favorite discussions. You both really came with things that our viewers needed to hear from both sides. So Teddy, Dutch, thank you both very much.
Thanks, Liz.